going to get started here in a couple of minutes, and as you can see, Brian's got it up and running and ready to go. Good morning and welcome to our third quarter economic forecast, or I guess review. This is Matt Patton with Cutler Investment Group. We are about 5 minutes from getting started. We appreciate you guys holding on, and we will get started here in just a minute. All right, good morning, everybody. Hey, Andy, if I could get you to press mute on your phone, please. All right, good morning, everybody. My name is Matt Patton. Thank you for joining us for our third quarter economic forecast and review. It is rising rates and economic growth. And this month we've got a new voice for you, or I guess this quarter we have a new voice for you. We have got Bryan Knutson from our Seattle office. And Bryan, thank you for joining us today. Bryan is a CFP and has been working with clients in the industry for many, many years, sits on our investment committee, and has got some pretty interesting ideas that he's looking forward to sharing with us today. So, Bryan, take it away.
Thank you, Matt. Good morning, everyone. Thank you all for taking the time to join us today. It's been an exciting environment for stocks, nerve-wracking to some degree, exciting. And so let's talk about some ideas on what's going on out there and what we think we might see going forward. So at the beginning, I'm just going to go over a quick disclaimer. Please keep in mind that this information is very general in nature. It's not intended to be targeted to any specific allocation mix. This isn't more for someone who's 50% stock than someone who's 80% stock. This is just a general overview. If you do have specific questions, please do direct those to your specific financial advisor, and they can certainly help you with those. Okay, so let's jump into it. One of the biggest discussions that's been going on in the marketplace, and one thing that has sort of disrupted markets over the last week or so, has been the impact of rising interest rates. And what we see on this chart, and this is over a long period of time, going back to the 1950s, but on the very right-hand side, we can see over these last several years, there has been an increase in what is called the federal funds rate. That is the rate that is set by the Federal Open Market Committee, which was chaired by Ms. Yellen, and now is Mr. Powell, and has names like Bernanke and such in the past. This group has control over the very shortest end of what we call the yield curve. That's going to be the rate that is set for very, very short-term loans. That had been, following the financial crisis, effectively zero. On paper, you probably see 0.25, because it was never really listed as zero, but more or less it was nothing. And what we have seen since 2015 now is a series of 8 increases to take it from 0.25 to 2.25. And that seems like a pretty radical change to some until you look at this history, and you can see that the last time before this recent 10-year period, where we were as low as as low as 2, I should say, was the early 1960s. So it has been 2 generations since we have seen anything even as low as we are today. And for those of us who I wasn't buying a house in 1980 because I was 7 years old, but for those of us who were, you probably recall the days when the Fed funds rate was 15 or 16, et cetera, to try to burst the inflation bubble. But the point of this slide is to show that, yes, we are increasing. Yes, we probably will continue to increase, especially if the Fed follows the guidance they've been giving, but we are still relatively low. In addition to this, what we have seen over the last 10 years now of this bull market, or call it 9 years, is a radical increase in the price of stocks. It might not feel like it over the last week when we're seeing some drops like we certainly are today, but take a look at this chart, right? So from 1997 to about 2000, when we had the dot-com peak, we had a rise in values of about 106%, as we can see on the left-hand side. If you look up at that, the box chart in the middle there, that led us to have an average PE ratio, price of the stock per share of relative to earnings, of 27. That is very, 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 very high. What we have seen now, if you drag over to the third column in that little box chart in the middle, is right now you might see articles or talking heads say that we are high on PE, but we're not anywhere near where we had been before. And then if you look down, you can see the rise in values since 2009. This is through the end of September. We had seen an increase in the value of the S&P index, the Standard & Poor's Big Stock Index, of over 300%. Unfortunately, what we've also seen, I don't have this on the chart, but participation rates in this increase have been very sadly low. Many, many people have completely left themselves out of this market recovery, and that is too bad. We're going to talk towards the end of the presentation about how that can actually impact people's returns. But what this shows really is just the dramatic and an ongoing increase in value over time, along with, though, some corrections along the way. So don't get the impression that this has just been a straight ride up. We have had healthy market corrections along the way to get where we are. And what we have seen in the last week especially is an increase, not so much in the Fed funds rate. That's very easily forecasted. The Federal Open Market Committee will come out and say if they are or are not making an increase in rates, in the short end of rates. What we are seeing right now is some unexpected, to a degree, increase in the longer rates. This is the 10-year yield, once again using a long chart to give you some historical perspective. But what we see right here is over this last window of time of the last several years, but then especially in the last week, is a bump up in rate. But once again, let's look back historically. When was the last time before this last 10-year period that we had rates as low as we have now? Never on this chart, right? We look back to even the late 50s, early 60s at the very left-hand side. We were in the 4s. Right now, we have all of this sort of Sturm and Drang and all this, hand-wringing that we're at 3.25. By historical standards, we are still, once again, very, very low, but rising. And so what do we get with this recent sell-off? There are many factors involved, but one impact of this is, remember that when bond rates rise, that doesn't mean bond prices are rising. It means they're falling. we are not seeing a purchase necessarily of 10-year bonds. We're seeing some selling, but we're also seeing a selling of stocks, part of which, and this is my projection onto what people's activity is right now, is that you see some selling in anticipation of buying new bonds at higher rates. So that is something to keep in mind going forward. One other factor that's been closely scrutinized by the Fed, who have essentially two mandates, what's called the dual mandate, is full employment, and we have some stats coming up on that, and normal levels of inflation, somewhere in that 2 to 2.5, maybe 3% range. Very unlike a place like Brazil that's going to be running at 18 or Argentina at 30, given, for a given point in time. We are much more controlled as much as possible in this area. But what do we see right now? This is the 12-month period ending August of 2018. And you can see at the very top that says all items. You can't read it necessarily, but I can tell you that that rate is about 2.3, give or take, for the aggregate. So the price of all of these factors together, if it was $1 last year, just hypothetically, it's $1 and about 2.5 cents right now. Okay, but where did that increase come from? If I look down this chart, I see not very many of these have moved up or down that much, except energy. Right? What do we see there? The price of oil, which has been hugely volatile over the last, say, 5 years, had gone from over $100 down to 30-some dollars, back up again, and it's now back into the in the high 70s, 80s, and right now, I believe the last price I saw was about 85. So a huge change in price there has led to some increase in gas prices. Right? We're not getting $2.40 a gallon anymore, at least not in Seattle. So we see some increase there. However, in other time periods, there will be other aspects of this that are moving us up or down. One thing that I thought was interesting here is if you go about 2/3 of the way down this chart and you see the line item for apparel, so for clothing, that has gone negative. Some of that because of production costs, some of that because of choices people are making to maybe not buy items that are as expensive as they have in the past. But that I thought caught my eye as being unusual. Okay, so what is another one of those dual mandates? What is the other dual mandate? That is unemployment rate, trying for the Fed, I should say, excuse me, to keep full employment. Well, from an academic standpoint, full employment, and for my economics classes, was somewhere around 4%. Where are we at right now? The latest number is about 3.7%. You can see big peaks and valleys in this chart over time. It goes back to the 70s. And we can see some high points along the way. So from a negative perspective, high unemployment, 9% in 1975, 11% almost in 1982, 10% in 2009, and that is back down now to 3.7. A radical and positive, for those who are looking for work, of course, change in the employment structure. What we were not seeing, though, for quite some time is any real wage growth, any real noticeable, tangible wage growth. If you look at the blue portion of this chart down below, you'll see even as unemployment was dropping, wage growth was just sort of bumping along. That's where we got a lot of pushback from economists and talking heads saying, we're getting lower unemployment numbers, but we're not getting quote unquote real jobs. Well, okay, it was a fair argument at the time to a degree, but now what we're starting to see is some stabilization and upward mobility on the wage growth side. But one cautionary tale there is look at the 50-year average, once again, sort of that box up in the upper end of this chart. The wage growth 50-year average is over 4%. We are somewhat encouraged to see this at 2.8%, right? If this continues to grow in a historical average level, we will see more inflationary pressure, which then leads to the Fed, once again, needing to reconsider or continue to consider what their Fed rate increase schedule will be. All of this loops back in again to the impact on stocks and on bonds. Okay, so what do we know about the Fed? What we know right now is that they are not very uniformly decided on, and the members, the actual voting members of the Fed are not very, they're not finding consensus on where they think rates will be. There's a lot of lines here, but key in on the red dots. The red dots are the Federal Open Market Committee median. That's the highs and the lows. You bring them all together. Where is the average? Where is the middle ground? in June of 2018 has already passed, but let's look at June of 2019, the third line over. The expectation is that Fed rate will be about somewhere either 3 or 3.25 next year in the middle of June, the middle of next year. Where would that put us relative today? Well, remember that we're at 2.25 right now. So if we got to 3.25, that would, of course, be 4 more rate rises. There's not actually time for that right now, unless they really consolidated their schedule and just kept voting them in, not only once a quarter, which has been sort of the norm. So that's not likely, but the trend is that the Federal Open Market Committee continues to think we'll have rate rises. The difference now from what we've seen in the past is it does seem more so like bond investors agree, that we were seeing a big disconnect between Fed expectations and market expectations as far as where rates could end up. Those are starting to come together. One other thing to note here is in June of 2020, once again, the red dot from the Fed is assuming about a 3.5. And then going forward, though, take a look after that kind of dotted line, look over at the longer run. The consensus there from the Federal Open Market Committee, the Fed, is to come back down a bit. So it's not necessarily saying that they're going to rise them up and then pull them right back down, but they do seem to be indicating that they do see the need to increase beyond even what they think might be the longer term run, and that could be to try to temper some of this inflationary pressure that we're seeing. Okay, and what do we see from a practical impact that could be affected by changes in interest rates? I think this is an interesting chart here because this shows the difference between different types of mortgages. This is from Freddie Mac, the national agency that assists with mortgages. And what we see on the left-hand side is where rates were in October of 2017. So this isn't 5 years ago. This is 1 year ago. 1 year ago, the average 30-year rate was about 3.7. Right now, best information is it's about 4.7. That's on a 30-year fixed rate mortgage. One thing to keep in mind on this is the Fed funds rate, the rate that the Fed determines, that does not directly impact 30 and 15-year mortgages. Those are supposed to be what's called free float. They will rise and fall to some degree based on actual Fed actions. But if you look back historically, there was a big spike in interest rates, in mortgage rates, I should say, about 4 years ago without any rate increases. It was on the expectation of a rate increase. So these can move ahead or behind, but the one down at the bottom, the 5/1 year arm, that is pegged to the Fed. So that one moving up is from Fed activity. The other rates moving up is not, but what do we see? They are moving in concert with each other. And on a practical level, I did a little hypothetical here I think is interesting. On a $250,000 mortgage balance, which many of us in Seattle could say, yeah, it'd be nice for a studio condo, but for the national average, that's a healthy size, it's considerably large mortgage for most parts of the country. With that level of mortgage on a 30-year window, if you have a 30-year mortgage, if you have a 1% change in interest rates, if you could have got a 4 and now you're going to get a 5, or you could have had a 3.5, now you're going to get a 4.5, the effective increase in the amount of interest you pay is $54,000 over 30 years. That's a difference of $150 a month, and for many households, that is a significant difference. So that could directly impact the willingness and the capability of many buyers to go out and make a purchase that they would like to make. Also, from a more of a taxation perspective, now that we have some changes in deductibility for home equity lines, now that we have a much higher standard deduction, which can somewhat curtail the benefits of a mortgage deduction, we could start to see some changes in how people view home ownership, and not necessarily with the outcome being we want to make a buy. Okay, so how does this all impact the equity markets? Let's take a look. What we've seen up at the top chart here is this is very similar to what we saw way back on slide 4. This is about a shorter time period. This one in particular is 5 years. We have seen, with some corrections along the way, a steady trend up in values from 2014 to 2018. We've had some flat years along the way. 2015, not much happened. 2014, not really much happened. 2016 was great, 2017 was gangbusters, but the trend has been up. However, what do we see on that bottom chart? This doesn't even include yesterday or today. We saw a sharp downturn based, I can't say solely because there's always other factors, but largely on the rise in interest rates, which was very unexpected, as I said before. And what is the market not like? Uncertainty. We've all heard it, and this is case in point. Look at those drops. 0.8%, 0.5%, 0.3%, boom, boom, boom. We just lost 1.6% over the course of 3 days. You add on today, which is still looking pretty rough, and we could be looking at a drop of 3.5% in the span of a week, right? So this corrective activity can happen quickly, and it can happen just based on a myriad of news items, like in this case, mostly interest rates. Another item that's been getting a lot of discussion and scrutiny is the difference in returns between growth-style stocks and value-style stocks. And we could spend an hour talking about the differentials, and I could debate with anyone who's interested about why I don't think the distinction is as clear as some might think. But basically what this looks at is the difference between returns of a growth style and a value style. If this line is trending up, that means value is more in favor. If it's trending down, it means the growth is more in favor. What do we see over the last, especially 4 years? Very much a growth leadership type environment. And I've had discussions with some clients myself about how a value is outdated and that's a passe style. Somewhat sounds like the year 2000 for those of us who remember that, so please keep that in mind as well. However, what I'll caution them back with is take a look at the middle part of the chart. From 2000 to 2009, value carried the day. It wasn't even close, right? I mean, look at that trend line is hugely in favor of value. What is the point of that? We don't know necessarily which style is going to lead from day to day, but what we do know is value tends to have much lower volatility. It pays out more in dividends on average. So having some aspect of both is a prudent idea, and that is something that a sound asset allocation can help with. This next chart is going to somewhat give us the same type of information, but it does it in a little different way. This is looking at the forward price to earnings expectations. So this is based on expectations, not necessarily on realities, not past realities, of what the market is expecting from growth style stocks based on the growth index versus the value. What do we see historically? A much higher average forward PE for growth stocks. And that makes sense to us because growth tends to be the higher flyers. It keeps more money internalized for R&D, et cetera. But what did we see during the market crisis? Those came together, right? Looking at 2008, 9, 10 period in the middle, they started to just land right on top of each other. Since that time, growth has gone back to its somewhat traditional leadership. But what I'm most interested in is look at the very end. Growth has had, and this is somewhat changing this week as we're getting big drops in Amazon and Apple and whatnot, but growth was starting to see a big pickup again in forward PE, where value was a much more modest pickup in forward PE. The punchline to this slide is that this can, based on history, this can be a good indicator that that gap could be looking to start to close, and we might not see the same type of leadership. And one big reason why we might see some change in that separation between growth and value is that the S&P, the Standard & Poor's Index, just made, at the end of September, a very significant change in some of its underlying sectors. In particular, what happened here is the telecommunications sector, which was essentially Verizon, AT&T, and some Flotsam and Jetsam, it was renamed the Communication Services sector, and there was a reconstitution in its holdings. And in particular, if you look down at that last line there, this change affects major stocks: Facebook, Google, Netflix, and Disney. I'm guessing most of us know those companies for sure. Those are now part of the communication services sector. And you can see in that box chart there, the previous weight before this change in September was 2%. 2% of the S&P index was weighted to telecom. And once again, like I said, it was essentially AT&T and Verizon and just some other very minor players. That is now a 10% weight. So that is significant. Go down to technology, it was 27, it is now 21. Still large, but certainly not as large as it used to be. And consumer discretionary went from 13 to 10. So now, going forward, communication services and consumer discretionary are, from a weight perspective, the same. That is significant. And the other part of this that is very interesting in that value versus growth discussion is that telecom was very much looked at as a value sector. Technology and consumer discretionary could not be more growth style sector. And now what we see is some coming together of those different aspects. This can be very important, especially because so many investors purchase sector-based ETFs, exchange-traded funds, and this can have a big impact in how those are viewed, purchased, and carried going forward. What about the non-U.S. portion of the stock market? This chart is very similar to the one we saw back towards the beginning, except that this also overlays the ACWI index, the all-country world index, except for the U.S., right? So this is every investment, well, almost every, I guess you should say, investable market in the world, except for us. Let's take a look at the chart in the middle first. The most recent PE, price to earnings ratio for the S&P is almost 17. Its 20-year average is about 16. So like I said before, we are somewhat elevated, but nowhere near what we were in 2000 and some other time periods. However, let's take a look at the ACWI ex-US. It is at about 13 with a 20-year average of 14. So my simple math tells me one of those is over its average, one of those is under. Let's slide over a bit. The dividend yield, the amount that I get paid on average for holding my stocks. This doesn't include my bonds, this is just my stock. The dividend yield for the S&P is at just about 2. Its 20-year average is just about 2. The ACWI is at almost 3.5. Its 20-year average is 3. That tells me two things. First, its average dividend yield is higher than its historical average. That's nice. Second, it's well over 50% higher than what I would get from an average U.S. stock. That's also good. So if we are seeing somewhat more defensive characteristics from investors, if we are seeing that perhaps the S&P has needs some air to be let out of its tires, one area that can benefit from that is non-U.S. stock. Let's look down at that comparison of returns between domestic and foreign stocks. Once again, we see that same number for the S&P rise since the market low of over 300%, which is huge. What do we see for the ACWI ex-US? It has gone up for sure, but it's up 115%. But here's a quick math lesson on this one as well. If I look back to 2008 and I see where that peak point is, right towards the middle of the graph, if I have something, for simpler math, if I have something that is $1 and it goes down 60%, that means it's now worth about 40 cents. What do I need for that to get back to just that same dollar that it was before? It has to go up 150%. What has it gone up? 115%. So what this tells me is that this index value is at a lower level now than it was in 2008. Altogether, this looks like an attractive class from a valuation standpoint. There are many other factors involved, but that strictly from that level, it looks attractive. What is one reason why non-U.S. stock returns have been as disappointing this year as they have is the continued impact of a strong U.S. dollar. And what we see here is, let's look primarily at the second part and the third part. So FTSE it's another index provider. Developed Europe Index. So we're looking at France and Germany and UK and whatnot. And on the right-hand side of that section, I can see in gray, the index return for this year is negative for a variety of reasons, trade concerns, tariffs, growth factors, etc. But it's down just under 2% in euros. What is that down in US dollars? We'll look directly to its left. Oh, about 5%. Why is it so much worse? Because the US dollar transition, when I take my euros and I swing them over to USD to reflect my actual return, it makes it worse in this time period. That's not always the case. There have been times when it is boosted, but not right now. FTSE Emerging Index, right? So this is your China, Brazil, the BRIC, Brazil, Russia, India, China, plus many other nations. That in local currency terms is down about 4. In U.S. terms, it's down almost 10. So once again, a not good year has become a worse year. But what does that also do? That continues to bring valuations down. So that's the good thing. Oh, and also one point I should make on this is Oh, no, sorry, I'll take that for the next slide. Let's hold off. Okay, in particular on emerging markets, this is an area that can be directly impacted by policy actions, both in their country, outside of their country, currency concerns, trade concerns, all different types of aspects. The blue line here is the emerging markets currency index, like a basket of currencies from those countries. The white line is the emerging markets index, the stock index. What do we see? This is 2017. This was the best performing asset class for stocks. It wasn't even close. Emerging markets was the clear number one, and I'll show you that on an ensuing chart, but it had a great year. What happened since that time? We're starting to see the impact of some policy-related actions, along with some other issues that have gone on in certain marketplaces. But in particular, to no surprise, China is a large part of this. And what do we see here? We see that U.S. hikes tariffs on steel and aluminum imports. We started to see some drop. U.S. announced a 25% tariff on $50 billion of Chinese goods. More drop. U.S. slaps tariffs on another $200 billion. We had seen some recovery during September. We see another drop. So this is an area where policy activity has jumped in to join some other factors that were going on and take an asset class that has very low relative valuations and just made them even lower relative valuations. What I had alluded to on the previous slide, and I'll say now, is over the period of 2003 to 2017, so a 15-year inclusive period to review stocks, the clear highest return is emerging markets on an annualized average basis. Along with that, the clear highest volatility, the highest standard deviation, we call it, has been emerging markets. It can be a wild ride. It has paid off, but there is a reason why not too many of us out there have that as the majority of our allocation, right? It is relatively small. It can add upside. We have to be patient. We have to be persistent. But that is, it gives you an idea of what has happened in that part of the marketplace this year. So taking a step back, overall, this is a time when we take a look at different asset classes and we look at valuations, we look at upside potential, downside risk, and reconfirm where we have allocation mixes for our clients. This chart shows all of the major asset classes that we track on a year-by-year basis, including emerging markets, which, as I said before, has been the highest average annualized return in this time, but also look at year by year to see where trends are going. I'm going to pick out three of these just to give you some examples. The brown box is bonds, and that is just the broad basket of bonds. The next page has a description of each of these indexes that are being used, but basically this is just the taxable, broadest possible world of bonds. What do I tend to see? It almost always finishes near the bottom of this sheet. The dark brown, like say for the years 2003 to 2007, it was the lowest, or 2003 to 2006, I should say, it was the lowest each year. And it's low in some other periods as well. But what does it tend to do? In most periods, not be negative. What do we want from our bonds? We want some stability. We want that recurring income. The times when I see bonds near the top or at the top means that stocks are not doing very well at all. Okay, let's look at another example. What about the black box? That is big, broad U.S. stocks. That is like, say, the S&P index or the Russell 1000, something like that. Just the broadest possible big stock coverage. It tends to end up in the middle, kind of like Goldilocks. It's not at the top, with a few exceptions. It's not at the bottom. A few times it's been near the bottom, but most of the time it's going to end up somewhere in the middle. Doesn't mean it's always going to have a consistent return from year to year to year, but it means that relative to other positions, it's going to generally be in the middle part. That is one large reason why that tends to be a very big slug of most people's allocation mix, because of that level of historical level of consistency. One last one, emerging markets, since I talked about it before, it is the sort of middle blue. If you look over to 2003, you'll see it in second place on this chart, right? It's in the second position. Looking over, you drag over from left to right, it finishes in the top two very often, right? 1, 2, 3, 4, 5, 6, 7, I think it was 8 times. It finishes in the bottom two very often. 1, 2, 3, 4, 5, 6, right? That is that wild ride that we were talking about. But keep in mind, at the end of the day, this is the future of developed markets, right? These are those marketplaces that have a history of transitioning over to become the next level. This is where a vast majority of the world's population lives. This is, especially with China and India involved, this is, an area that we want to continue to have exposure to, but we just, once again, need to be patient. Okay, and speaking of patience and the need to stay disciplined, this last slide that I have for you is from Dalbar. It's a research company based out of Boston, and it looks at the actual investor returns over a very large sample group that they have done some studies with versus the S&P 500. So this is strictly for stock funds. This isn't a blended allocation of 60 stock, 40 bond, or something like that. This is just purely on the stock side, which tends to be much more volatile. What do we see on the left-hand side of each of those time periods? That's the actual average investor return. What do we see on the right-hand side? The S&P index. One disclaimer to put in place here, the S&P 500 does not have any fees involved, right? So even if you just bought an S&P index fund and sat on it, you wouldn't get exactly that much, but you'd be pretty close. But what do we see in reality? People are not close. On average, investors are not meeting and certainly not beating that S&P index return. And why is that? There's a multitude of factors, but here's three big ones. The first one is expenses. People pay outrageous amounts of expense sometimes for funds and don't even know it. The second one is kind of a psychological side, kind of market behavior side. We jump in when things are hot, we jump out when things are not. So what you just did then is buy high and sell low, right? That's exactly what you don't want to do, but that's what people do. The third part of it is stretching, risk, call it. I'm a 50-50 person. I like to have half stocks and half bonds, but I'm going to stretch out and be 60 stock because I think stocks will do well. They don't do well for a while, and I sell them all. And it's happened. I've had clients that have done this for years and years and years. You chase returns. There's only one area that I know of where people are actively looking to overpay for stocks, therefore for holdings, and that's in the stock market, right? You don't go into Target and ask for the markup section. You don't go to Nordstrom and ask for things that are even more expensive than they already are. You go in looking for deals. Well, in this area, people tend to not do that. That can end up with poor outcomes for people. So I hope that this was helpful. Thank you all again for joining us. And that is what I have for you today. Once again, like I said at the beginning, if you do have specific questions about your particular situation or about thoughts on markets and interest rates and such, please reach out to your financial advisor. And once again, thank you very much for your time and for joining us today.
Great job, Bryan. Thank you very much. For those of you that want to hear more or send it on to a friend or colleague, this will be up on our website tomorrow, so you can listen to Bryan's thoughts in a little bit more details when you do call your advisor. Thank you, everybody, for calling in. We appreciate your time on this Wednesday morning and look forward to talking to you soon. Thank you.